We continue on the cash flows, and we're going to spend some more time trying to understand a few problems on indirect cash flow creations, right? So we're going to stick to indirect cash flows for the time being because this is important for our understanding to gauge what is the overall impact of transactions that companies do on the context of the company's financials, right? So this bit, if we understand well, then we would have mastered a lot of bits around financial statements. This is also integral to us being able to balance a balance sheet, right? So that bit we'll have to kind of get. Let's solve a few problems on that. So we're going to say an example where we are seeing a company reports a profit of 200 crore. Its depreciation is 50 crore. Receivables last year were somewhere to the tune of 50 crore, and this year are 120 crore. Payables were 40 last year and 20 this year. The company has planned a capital expenditure of 220 crore. Would the company need to raise money in the form of debt? If yes, how much? Create the cash flow using indirect method, right? So now we need to basically identify the cash flow using indirect method. When we are doing the cash flow using indirect method, remember we start with net profit, we add depreciation. Remember we had seen we remove an increase in any current assets, we add an increase in any current liabilities. In other words, we can remove a change in current assets and remove a change. This is the delta sign which I'm using for change, which is change in current, add a change in current liabilities. I'm going to use a change here, right? And then we can do a subtraction of capex, and we have to do a debt raised. This can only work if the net cash flow is positive at the end. We are assuming here that the company starts with zero cash, right? We are assuming that the company starts with zero cash, right? So now if we put in the numbers, we will see 200 coming here, correct? Then we will look at what the depreciation is and we will add that to here. So we will add 50, which is the depreciation. What is the change in current assets, right? Let's work out the change in current assets. So current assets are receivables. Last year is 50, this year is 120. So change in current assets is equal to 120 minus 50 is equals to 70, correct? Also look at a change in current liability, that's equal to 20 this year and 40 last year. So 20 minus 40, remember this year minus last year is minus 20, right? What do we do to change in current assets? We subtract it. So minus 70, and we will understand this in a moment. And what do we do to change in current liabilities? We add minus 20. So effectively we will end up subtracting 20, right? And then we have a capex of 220. We have to find out if the company has taken any debt such that we end up being zero or positive, right? That's what we want to find out. So we can do the calculation. That's 250 minus 70, that's 180, minus 20, that's 160, right? And 160 minus 220 is minus 60. So if the company raises no debt, then they will end with minus 60 as cash flow. Assuming they started with zero cash, this situation is not possible. So the debt raised has to be at least 60 crores. Correct? The debt raised has to be 60 crores. We'll do this again in a moment, but let's first look at the change in current assets. Receivables went up, which means money not received, which means money stuck, which means it is cash negative. This money did not come in, so you subtract it, right? Payables went down, which means money paid or more money paid. Last year it was 40 crore, this year is 20 crore. So you've paid that 20 crore, right? So money is gone out. More money paid is going to be cash negative. So you just look at the change and the change is added. The change is negative because now you are at 20 and earlier you were at 40 and that gets subtracted. Otherwise, if payables had gone up to let's say 120 crore, in that case you would have added 80, correct? And then you solve it and you get your answer as 60 crore of debt is needed. So if you have 60 crore of debt, this will become 250. We can work cumulatively. 250 minus 70 is 180, 160 minus 60 plus 60 gives me 0, right? So if I want to add at a 0 cash, minimum cash I need in terms of debt has to be 60 crore, assuming the company has 0 cash. If the company had a beginning cash, then you can use that as well, in which case they may not need the debt. Here we are assuming that there is no beginning cash and hence consequently the company will have to raise some debt, right? That's basically how we go about solving this kind of a question. Let's look at another one, and we now create a slightly bigger set of numbers. Company reports a profit of 2000 crore. Its depreciation is 350 crore. Receivables last year were 510, this year is 620. Payables were 340 last year, 420 this year. Company has planned a capital expenditure of 1220 crore. Interest cost is 100 crore. Calculate the CFO, CFI, and CFF cash flow from operations, investing and financing for the company, assuming that the company raises 800 crore in debt and pays 400 crore as dividend, right? Now we are going to make adjustments to the numbers. So we'll have to actually calculate everything. So we start with net profit plus depreciation minus change in current assets plus change in current liabilities. This, remember, is my cash flow from operating activities, but you need to note that you have to add interest here. So that's CFO, right? CapEx is straightforward. CapEx negative is my CFI, unless I have some sort of a amount that comes in there, and plus any debt raised minus any interest paid, which is the plus that we did here, minus any dividend paid is going to be my cash flow from financing activities, right? So that's the set of formulas that we're going to use. We can put all these numbers on an Excel and try and identify the actual numbers, right? Let's do that. So let's look at the numbers. We're going to look at net profit. We're going to add depreciation. We're going to less change in current assets. We're going to add change in current liabilities. We're going to add interest cost, and that gives cash from operating activities, right? Then we are going to do minus or less any capital expenditure, and that's the only item that is there, so that gives us cash from fine investing activities, right? Just do this along with me, it might be useful. Then we say net debt, so or let's put it debt raised less debt repaid, if they have repaid any, less interest paid less dividend paid, right? If there is dividend tax, that also comes here. So cash from financing activities, and then we get the total cash flow. Let's put in the numbers, right? What's the net profit number? We started with 2000 crore, depreciation of 350 crores. So we put in 2000 here, depreciation is 350, correct? Change in current assets. What are the current assets? Current assets, receivables last year were 510, this year are 620. So 620 is this year, and this is, remember, current assets and current liabilities. And last was 510. last year. And similarly, current liabilities, payables were 340 last year and 420 this year. So 420 this year, 340 last year. Can I find the change? Change is 110. Remember, this will get subtracted eventually in our formula. So we will make that change in the formula. We don't need to put a negative here. And this is positive. This will get added. And what is the interest cost? The interest cost is 100 crore. So 100 gets added. Let's do the formula here. 2000 plus depreciation minus change in current assets plus change in current liabilities plus interest cost. Correct? And that gives me my number, cash from operating activities. We can highlight it. What is the capital expenditure the company is looking at? 1220. So that's 1220. And I'm going to just subtract it. That's the negative cash from investing activities because money will go out. Correct? What is the debt raised by the company? Correct? So the company raises 800 crores in debt. So that's plus. Any debt repaid, that's 0. Less interest paid. Interest paid is the same that we added there. So interest cost was 100. Less dividend paid. Dividend paid was 400. The formula would be 800 minus 0 minus 100 minus 400. That's cash from financing activity net of 300. The cash flow total is going to be a sum of operating activities plus investing activities plus financing activities. Total cash flow the company makes is 1500 crore. So effectively the company has done some investing activity but has been able to completely fund it from its own operating cash flows, right? So effectively that's the set of numbers we get. That's how we solve for any such question and arrive at the final numbers. Does the company need to raise this 800 crore? Even if we remove this, they don't need to raise this 800 crore because they are generating enough cash. We can play around with these numbers, change some of these numbers to understand how do we go about putting this into the context, right? So effectively interest cost is 100 crore and we were trying to kind of calculate based on these data set. And receivables went up, so that was a negative exercise, negative to the cash flow. Payables went up, that was positive for the cash flow. That's a little bit interesting when we realize understanding the indirect methods and the cash flows, that current assets going up is, so increase in current assets is cash, increase in current assets is cash negative, right? Increase in current assets is cash negative. Now, conventional understanding says current assets should go up, but cash flow analysis says it is not really good for the firm, right? More on this when we reach the next set of discussions at some point of time in your course on working capital. But at this point of time, there is a divergence in what broadly cash statistics tell us. Increase in current assets are typically cash negative for the firm and in certain cases may be perceived as negative on the overall health of the firm, right? That's about it in this particular section. One more quick question for you to try and solve. Company reports a loss of 100 crore. Depreciation is 150 crore. Receivables were 150 last year, 120 this year. Payables were 40 last year, 60 this year. Company has planned a capex of 50 crore. Would the company need to raise money in the form of debt? If yes, how much? Create the cash flow using the indirect method, right? This time in this question, we start with a loss of 100 crore. Thank you.